Good morning, everyone. Am I audible?
Yes, ma'am. Good morning.
Morning, ma'am.
Good morning, ma'am.
Good morning. How was the weekend?
Great, ma'am.
Great. Okay,
Great,
everyone.
ma'am.
Good. Right. Okay, then. So we had a little bit of your fixed income leftover, which is your securitization that we had to cover. Right. So before that, though, any questions or doubts that we covered from fixed income on the last class? Yes or no?
No, ma'am.
No? Sure. Okay then. So let me just share my screen and pull up fixed income bit that we need to talk about. All right. Is the screen visible?
Yes, ma'am.
Okay. So I want you guys to pay attention. So first of all, what is securitization? So have you heard of this term securitization before? Yes or no?
No, ma'am.
No. Okay. So securitization is the process of converting an illiquid asset into a liquid asset, or rather converting an illiquid, or rather not converting a non-tradable asset into a tradable asset. To give you an example, what could be classified as a non-tradable asset?
Copyright,
Lands,
Land, yes. What else?
plant and machinery,
Plant and machinery.
Gold.
Okay.
building,
Gold can be converted into liquid. This thing, no, anytime.
goodwill,
Goodwills. Okay. So let's take an example of a home loan. You all know what's a home loan, right? Okay. In India, we call it home loan. In the US, they call it as a mortgage. Now, once you take a mortgage, can you trade the mortgage in the market?
no,
Like,
ma'am.
no, you can't,
No, ma'am.
right? It's an illiquid asset. But to give you a bit of history of what happened, there was this big commercial bank. It was, I think it was Salomon Brothers, and there was this guy who used to work for that particular mortgage department called as Louis Ranieri. He came up with this concept of securitization. So basically, securitization in this case, what he did is he converted your home loans into tradable assets. And how we did that, I'll explain the concept now, right? So let's say you have a person who wants to buy a property, right? But he can't upfront pay the entire money. So he wants to take a loan to pay off the property or buy the property. So he obviously goes to the bank, right? Now, will bank loan him the money SA, or he'll check something?
They'll check the genuineness of the property and stuff like that.
Yeah, additionally, he'll check your credit rating also, right?
Yes, ma'am.
Yeah. So the criteria to take a home loan in the US was that you have to first give a little bit of down payment. You need to have a good credit rating, and you need to have a steady source of income. Are we clear till here?
Yes, ma'am.
Okay. So what the bank used to do then is grant the loan to the person, and then that was not it. They used to take the house as the collateral as well. Why? Because in case if this guy defaults on paying his installments or EMIs, then the bank can take the house, sell the house, and recover the money. Are we clear till here?
Yes, ma'am.
Yes.
Yes, ma'am.
So once the banks used to give out the mortgages, they used to pool all the mortgages into something called as a mortgage pool. Now bank doesn't just give home loan to one person, it can give home loans to multiple people, right?
Yes, ma'am.
Yeah. Now here's the thing. Banks are competitive. Like one bank might give you a home loan at lesser interest, one might give you at a higher interest. Obviously, if you're going to this thing, you look at which bank will charge you less interest, right? When it comes to a home loan. Agreed.
Yes, ma'am.
Yeah. So let's say this bank is quite popular in giving home loans. So what will automatically happen is more and more people want to borrow, correct?
Yes, ma'am.
Yeah. But now bank is at a fix. They don't have enough funds to give. So like our center, or rather like our deposit accepting banks, even in the bank in the US, they have to maintain a certain ratio of deposits as stipulated by their central bank. So let's say if the bank has a deposit of 1 crore, out of that crore, maybe only 50 lakhs they can give out as a home loan, not more than that. But then there are people who are coming and asking to borrow money, right? Yes or no?
Yes, ma'am.
Yeah. So bank needs, in other words, funds or capital, correct?
Yes, ma'am.
Yeah. So now what they do is they hire someone called as a special purpose vehicle or special purpose entity. This is a private, usually a private entity, and their job is to find out the ways to raise that capital or get that fund, not raise capital, let's say, get that funds for the bank. Are we clear till here?
Yes, ma'am.
Okay. So what does this SPV do is it takes over this mortgage pool. As we discussed earlier, mortgage pool is all these home loans the bank has given out. They pool together into something called as a mortgage pool. Are we clear till here?
Yes, ma'am.
Okay.
Yes, ma'am.
So what the SPV does is it studies the mortgage pool and it splits it up into 3 tranches or slices based on your credit rating. You all know what is credit rating now, right?
Yes, ma'am.
Yeah.
Yes, ma'am.
So what does AAA stand for? Let's say hypothetically, this mortgage pool consists of 10 mortgages. To keep it simple, 10 home loans. Are we clear till here? Okay. Now,
Yes.
let's say in the first tranche, they have put 3 mortgages. Let's say mortgage 1, mortgage 2, mortgage 3. What does this mean? The people who have borrowed this home loan or taken this home loan, their credit rating is AAA, meaning they have a very good source of income. Their credit rating is very good. That means the chance of default is also very less. Is this clear?
Yes, ma'am.
Okay. This one, let's say, has mortgage 4 and let's say mortgage 5 and let's say mortgage 6. Which means they are rated BBB, which would mean these guys have a decent enough credit rating. There might be a slight chance of default. Are we clear with this?
Yes, ma'am.
Okay. And let's say this one consists mortgage 7, mortgage 8, mortgage 9, and mortgage 10. Now, those are put in this particular slice, their credit rating is CCC, meaning it's junk rated, meaning there is a very high chance that these guys default. Correct?
Yes, ma'am.
Yeah. How does this guy get this rating? He takes the help of something called as a credit rating agency. We discussed about credit rating agencies previously, right?
Yes, ma'am.
Yeah. So once the pool is analyzed and sliced into tranches based on the credit rating of the underlying mortgage owners, then this SPV uses this as an asset and issues a bond on the back of it, which then it becomes an asset-backed security. Remember we talked about secured bonds?
Yes, ma'am.
Yes,
Yeah? It becomes a secured bond. Now, as in a bond, what happens? You take principal value. In return, you pay the investor periodically, either
Coupon.
quarterly, semi-annually, or annually coupon payment. Are we clear till here?
Yes, ma'am.
Okay.
Yes.
So let's take the first tranche, which consists of all of these mortgages. Let's say he's issued the bond on it. So let's say he's taking maybe 1 million from the investor. In return, he's offering, let's say, 3% coupon to this investor, right? Similarly, he does this on this. Now this guy gets a lump sum amount of cash, correct?
Yes, ma'am.
Yeah. Which then he loans it out to this fellow. Then this guy loans it out to the mortgage this thing who wants to borrow more money. Is this clear now? Guys, yeah. So basically what this guy did is he took illiquid assets, he securitized them, and he sold them in the market as asset-backed securities. In this case, more specifically, they're called as mortgage-backed securities. Now, this guy got a capital in, or rather he got funds, which he then gave on to this guy, and he's charging obviously an interest to this guy. He's not going to give it for free, right? Yes or no?
Yes, ma'am.
Yeah. Now, this guy has to pay this fellow coupons. Where will that coupon come from? Coupon amount. Where will it come from? From the underlying
the borrower.
EMIs.
Borrower.
Yeah, from the
From the borrower.
borrowers. The underlying EMIs that are paid on the home loans, correct? Yes or no?
Ma'am.
Yeah. Now, investor might be at risk if any of the underlying guys default, which is fine because then you can sell the house and give him the money, right? In case there's a default. Agreed. Because it's a secured bond. Is this clear?
Yes, ma'am.
Okay. So securitization became like a big thing, but then it got misused during your 2000 or just before your 2008 crisis. And then it caused you a widespread US market crash. Have you guys seen that green color video that I recommended? Yes or no? Crisis of credit. Did you watch it? Hello? Am I audible?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
So did you watch the video or didn't watch the video?
Now
Didn't
we'll
watch
watch it.
video.
Then watch it na today. Okay.
Okay.
Okay, ma'am.
So now you can do securitization not just on your home loans, you can do it on car loans as well, right? That time, the pool of car loans will not be called as mortgage pool, it will be called as your collateralized debt obligations, right? When it's a pool of your mortgages, it's called as CMOs, collateralized mortgage obligation. Is this clear?
Yes, ma'am.
Okay. So I've written the workflow here, how it happens. So borrower wants to borrow loan from bank. Bank looks at the amount, asks for collateral. Borrower owns property or gives that as collateral. Then the bank gives money to the borrower and in return the borrower pays EMI and these loans are secured as they are backed by the home, right? Bank holds the property deed, which is the mortgage papers. What the bank does is pools all the mortgages together and creates a mortgage pool, right? So the more loans the bank hands out, the liquidity or the liquid holding the bank holds will go down, right? So they may not be able to provide more loans. That is when they appoint a special purpose vehicle or special purpose entity, right? The SPV will take over the mortgage pool, pay the bank the cash associated to the value of the underlying mortgages, analyzes the underlying mortgages, splits them up into tranches based on the credit rating of the underlying mortgage payers. Then they hire the credit rating agency to rate the tranches, and then the mortgages have 100% recovery rate. What does 100% recovery rate mean?
Ma'am, if we give 100 rupees as a loan, we will get back, we will get 100 rupees as it is.
Correct. Okay. Now the SPV issues bonds on the back of the mortgages funds after they're securitized, referred as mortgage-backed securities in this case. Is this clear?
Yes, ma'am.
Write
Yes,
this
ma'am.
down. Done?
No, ma'am.
Ma'am,
Yes.
in the fourth point, similarly, multiple people borrow and give property as collateral,
Mhm.
where now the bank pools all of these deed forms a mortgage pool, which what is this now? I didn't understand.
So basically, the property papers, right?
Yes,
They all pulled together and kept under something called as a mortgage pool.
okay, ma'am.
Okay. So when the bank needs more funds, this guy takes over this pool
Okay,
and he gives him the money, right?
okay,
Or he'll get the money by securitizing it and selling it to investors, right? To put
okay,
it in a gist, you can look at it this way. Let's say bank needs to give this guy money, right? Let's say 1 million. This guy is taken over, let's say, the property papers, securitized it, issued a mortgage backed security worth 1 million, where he's paying a 3% coupon. Sells it to this investor. Investor gives him a million. What does he do with this million? He gives this million to this guy, charges him 5%, right?
yes,
2% is making profit here also, correct?
yes,
This guy loans it to this guy at 7%, right? Get it?
yes, ma'am. Ma'am, after which what we have to write, ma'am?
Write down what is written here. No, I've written down
With uh,
here all of these lines. It's an explanation of this diagram.
okay, ma'am.
Kritika, I need your email ID and phone number. Post it on the chat privately to me, please.
Ma'am, when the bank is investing, like at the last step, what if the investment goes default or it cannot repay back the same amount? What happens to the mortgaged property then?
The property gets sold, no? That's how they recover the money, right?
Okay, so the basically the investor who has put his property on mortgage will allow the bank to do an investment.
Not an investment, Pragati. Simple this thing. You want to borrow money from me. I'm okay to give you the money, but I need some collateral, right?
Okay.
So you hand over your property papers to me. So in case if you default, then I can sell your property and recover my money, right?
Yes, sir.
So apply the same concept here. Bank is giving loan for home, but they will take the homes or the property papers from the owner,
Okay.
right? Till what? Till they fulfill paying all their loan and they return the property papers back to them. In
Okay.
case in between, if he defaults, then the bank can sell the property and recover the money. Yeah.
Ma'am, that is okay. But see, in the last step, as you've mentioned, that MBS 1, tranche 1, here what bank is doing is they're reinvesting that money. Like,
They're not reinvesting the money, Pragati.
there is a
They're
little bit of
creating more money. Why? Because they don't have enough money to give out on more loans, right?
okay.
So now what happens is if I've bought, as let's say, if I'm an investor, I bought this mortgage backed security, it makes up of underlying 3 mortgages.
Okay, ma'am.
Now it's like a bond. What am I expecting? Fixed returns, correct?
Yes, ma'am.
And there's a maturity on it as well, correct?
Yes, ma'am.
So if there is no underlying default on the mortgages, no issues. I'll keep getting my coupon payments. At the end, I'll get my principal amount back.
Okay, ma'am.
Is it clear now?
Yes, ma'am.
Ma'am, tranche 1, tranche 2, and tranche 3 represent different rates of interest.
Credit rating, different credit rating.
Credit rating.
Yeah, of the underlying mortgage holders.
Ma'am, can you please show the last diagram?
Sure. Done?
Yes, ma'am.
Just a moment.
Sure.
Ma'am, I have a little doubt. In this case, the borrower is somebody like me who's ready to mortgage her property in order to get funds. Who is the investor in the end then?
Some other person. Obviously, you will not put your own property and then buy a mortgage backed security on that, right?
Yes, ma'am.
Done now? Yes or no?
Yes, ma'am.
Everyone's done? No? Okay, let me know once you're done.
Yes, ma'am.
Ma'am, foil is also a hello.
Yes, go ahead.
Yes. Ma'am, foil is also a part of the loan.
Sorry, what is also part of the loan?
Foil, FOIR, fixed obligation income ratio.
No, not this. That is different.
Okay.
Right. Have you finished writing?
Yes, ma'am.
Okay. So that
ma'am.
winds up your fixed income topic. This bit was remaining from the previous class. So that also winds up your capital markets class. So, or rather, the two instruments that is used to raise capital, which is your shares and bonds, right? Okay, let me just close this bit. So the next one we're going to talk about is money markets. Now, as we discussed in your financial systems class, money markets is used for what?
To raise short-term fund.
To raise short-term fund. Yes, that is from an issuer's perspective, from investor's perspective. Make more money. Investor's perspective, why would someone invest in money market instruments?
Faster returns, like fixed returns.
Faster returns, fixed returns, or even they don't want their capital to be tied up for a long amount of time, right? Because when it comes to shares, your principal doesn't get returned to you because there's no maturity on shares, correct? So the only time it will be returned to you in case if the company winds up or goes bankrupt. Agreed?
Yes, ma'am. Yes,
Yeah.
ma'am.
On bonds, we have maturity, depends on whether it is small term, mid term, or long term. But the longest or the maturity on a bond is usually a year, right? Or more than a year. So there also your capital is tied, right? Yes or no? Yeah. So what if investors don't want their capital to be tied for a long amount of time? That's when they can invest in something called as money market instruments, right? So what is money market? It is an important part of your financial system. It promotes the growth and development of the economy, right? What are the features of money market? It's a highly liquid market for short-term investment because all of your instruments of your money market has a maturity of less than 1 year. Sorry, just give me a second. All right. So other like your shares and bonds, in terms of your bonds as well, you have unsecured bonds and you have junk rated bonds, correct?
Yes, ma'am. Yes,
Yeah.
ma'am.
And when it comes to shares also, a company may not, it might start off well, but later it might tank or it's not doing very well. So that's riskier, right? To invest in.
Yes,
Yes or no?
ma'am.
Yeah. When it comes to money market instruments, your money market instruments are highly secure in the form of investment, meaning the chances of issuer defaulting on money market instruments is very, very low. The reason being, your money market instruments are usually issued by high credit rated issuers. We discussed about credit rating in the last class, right?
Yes, ma'am.
Yeah. So if your credit rating is high, the chances of default is quite low.
Low.
Is this clear to everyone?
Yes, ma'am.
Yeah. And your money market instruments are usually issued and sold in the OTC market. That is when the first time when it is issued. After that, in the secondary market is always traded in the OTC market. When we talk about OTC market, what are the features of OTC market?
We know the counterparty and we can
Prices are
negotiate with the price.
And
We can negotiate with the price.
yeah, after that, what else is there?
Default risk is low.
settlement is not guaranteed if it will
Settlement is not guaranteed because we don't maintain margins. Yeah. Is this clear?
Yes, ma'am.
So write down what is money market and features of money market. Why is the batch so dull today? What happened? Everyone still waking up? What? Guys?
yes,
No,
ma'am.
ma'am. Everything is good.
Everything is good, but then I'm not getting the same this thing like how we had in our first two classes.
Ma'am, I have a doubt.
Yeah.
What are the examples for OTC market? Is there something like NSE, BSE or something?
So NSE, BSE is a stock exchange market, right? When you buy and sell on the exchanges, it's the order driven market or the exchange traded market. If I buy and sell from you, that will be OTC market, right? So it's just as simple as directly contacting you and making a deal.
Okay, I'll tell you that I'm dealing with OTC market. That's
No, like if you want to buy from me, you know me, right?
yes.
So that will be OTC market.
Okay. If I don't know, then that will be
That is, if you place any order on the exchange, it's called as exchange traded market, because at that point of time, you don't know who is your buyer or seller, right?
yes. Okay, ma'am.
Don't worry, once we do your level 2 and we do OTC trade life cycle, no, it will make more sense.
Okay, ma'am.
Ma'am,
Yes.
ma'am, I came across a few words, so I just wanted to know whether we have covered them or we are still yet to cover them.
Mm-hmm.
Ma'am, the words are warrants, charts and overlays, indicators, algorithmic trading, trade cycles, and trade versus orders.
Okay, so warrants will cover in your corporate actions class.
Okay,
Okay.
ma'am.
What were the others?
Charts, overlays,
Art overlays.
chart
Chart
and
overlays. When it was in the PPT.
yes, ma'am.
What's the full sentence?
Ma'am, I don't remember that. It just
Okay.
came, like, they were, yeah. So I
Okay.
couldn't really make them out.
Algorithmic trading is basically, it is a setup that the traders use where they will feed in the market reports and analysis and generate what stocks to invest in.
Okay, ma'am. So basically, they give us ideas where to invest.
Yes.
In which stocks? Okay, ma'am.
And then your trade cycles and orders, that will be covered in your level 2 when you do trade life cycle.
Okay, ma'am. Thank you.
Sarita Chauhan, is this your first class? I don't remember seeing you in the other 2 classes.
Yes, ma'am.
Okay.
My first class.
Okay, hang on a second. Did you guys finish writing, by the way?
Yes, ma'am.
Yes, ma'am.
Just give me a moment. Sarita, can you send your phone number and email ID to me on the chat separately, please?
Okay, ma'am.
Ma'am,
And
could you please scroll a little up just for a second? I just missed one sentence in securitization.
yeah, I'll do that. Rishita, I need your email ID and phone number as well, please.
I have sent it.
Not Ritika, Rishita.
Yeah, I have sent.
Hang on. No, Ritika sent it. I want Rishita. RIS. There's a Rishita as well.
Yes, ma'am.
When you sent it? Last class?
No, ma'am.
Acha, got it now. Yeah, right. Guys, just give me a quick minute. Let me just finish copy paste these details. Om Kumar, I have your details already. Right. So, yeah, here we go. Finish writing?
Yes, ma'am.
Okay, can I continue then? All right then. So let's look at the advantage and disadvantage of your money market instruments, right? This is from the investor's perspective, right? Issuer's perspective, it's simple. He doesn't, or rather he wants to borrow for a short amount of time. So instead of issuing shares of bonds which are long-term instruments, he'd issue short-term instruments. Are we clear with this?
Yes, ma'am.
Okay, so let's look at the disadvantages of investing in money market instruments as an investor, right? So one is, like I said, short-term investment. The maturity on any of your money market instruments is always less than a year, right? So I'm going to note of it. Maturity on money market instruments are always less than a year, or rather less than 365 days. Is this clear? Okay. The returns are mostly fixed. We have fixed returns. So in shares, it fluctuates. In bonds, we know it is fixed. But in bonds, we have variety of bonds, plus depending on the credit rating and all, the coupon payments may vary from bonds to bonds, right? For issuers, it's a low borrowing cost. For investors, the money is not tied up for a long amount of time. Now, what is the disadvantage? The disadvantage is the returns that you get, the fixed returns, is usually less than your capital market instruments like your dividends on shares and coupons on your bonds. Are we clear with this?
Yes, ma'am.
Yeah.
Yes, ma'am.
Some of your instruments have a high initial investment. What does this mean is you can buy a share as low as even up to a penny or a dollar, right?
Yes, ma'am.
Even a bond, the least you can, or the least principal value a bond can be sold at is even $100 or even $1,000. But when it comes to your money market instrument, the principal investment will sometimes be quite high. And then when we talk about the examples, this line will make more sense. Is this clear to everyone?
Yes, ma'am.
Yeah. So
Yes,
write
ma'am.
down what is advantages and disadvantages of money market instruments.
Ma'am, these instruments are transferable, right?
Some of them are, some of them aren't. And we'll discuss which are and which aren't.
Okay.
Done?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Okay, so who are the issuers of money market instruments? Your issuers of money market instruments are usually your banks, investment banks, institutions, and governments. Okay,
Okay, ma'am.
write that down and we'll start looking at the various money market instruments. Under that, the first one that we're going to look at is something called as interbank lending. Done?
Yes, ma'am.
Okay. So the first money market instrument we're going to look at is something called as interbank lending. And as the name suggests, it's between what?
Two banks.
Between two banks. Simple, right? So what is interbank lending is when one bank has a short-term deficit of cash, cover that short-term deficit, they might go to a bank that's got surplus money, right? Now, the first question that might come to mind is, hang on, it's a bank. Why would it have a deficit of cash, right? Because it's getting deposits, correct?
Yes, ma'am.
Yeah. So I don't know if you've heard of these terms called CRR and SLR ratios.
Yes, ma'am.
Yeah, in India,
Yes, ma'am.
our central bank has stipulated or published a regulation on deposit accepting banks that if they accept deposits, a certain percentage of that deposit has to be maintained as cash reserve ratio at all times, and something called as statutory liquidity ratio at all times. In India, I'm not sure if these percentages are right now. So it's usually 4% and 18%, right? Why does the RBI stipulate or central bank stipulate that the banks have to keep this amount of money at all times, at any given time?
Security.
Security.
Otherwise, bank will
In
lend.
case the bank is at a loss or some deficit amount, then they can borrow the reserve money from the central banks. I mean, center, not the central bank.
Okay, that could be a reason, but there's another reason. If we allow the banks to reinvest all the deposits that they get out as loans, if tomorrow you go to remove your money that you're deposited in the bank and they say, oh, sorry, I gave the money that you deposited out as loan, will you be happy?
No, ma'am.
No, right?
No,
So at any given time, the bank has to reserve a ratio of liquid cash, right? Is this clear?
Yes, ma'am.
Yes, ma'am.
Okay. So now what happens is, we know, as usual, we talked about this, banks are greedy. They might over loan the money and they might dip down on their deposits or the reserve that they have to keep, right? So they create, or it creates a short-term deficit. Now they need to cover that short-term deficit. Why? Because if the central bank finds out that these guys are not maintaining that, what's going to happen? They'll get fined. Agreed?
Yes, ma'am.
Yeah. And if they repeatedly do it, the central bank can revoke their license as well. Correct?
Yes, ma'am.
Yes.
Yeah. So in order to cover the short-term deficit, they would go to a lending bank and borrow the money. Now, based on how long they want to borrow the money, your interbank lending is divided into a couple of categories. You first have something called as call money, which is borrowed in the morning, returned in the evening. It's just borrowed for a day. Is this clear?
Yes, ma'am.
Yes, ma'am.
Overnight money you borrow today, return tomorrow. Weekend money you borrow on a Friday, return on a Monday. Intraday money you borrow in the morning, you return in the afternoon, right? Notice money you borrow for greater than a day but less than equal to 14 days. And then you have term money, which is borrowed for more than 14 days but less than equal to 365 days. Is this clear?
Yes, ma'am.
Yes, ma'am.
Okay, so obviously when the lending bank loans this money, he is not doing it out of the goodness of his heart. He's going to charge an interest, right?
Yes, ma'am.
Yes,
Yeah.
ma'am.
Sorry. So remember we talked about floating interest rates in your financial systems class, right?
Yes, ma'am.
Yes, ma'am.
So interbank offer rates, that is usually what is the rate one bank would charge the other when they're loaning the money, right? So how is the interest calculated? It is the principal into the rate of interest into your day count convention. You all know what is day count convention now, right?
Yes,
Yes,
ma'am.
ma'am.
Yeah. So for example, if a bank borrows, just to keep it simple, $1 million for 2 days, and the SOFR rate is 4%, which is your floating interest rate on US dollars, and we'll discuss more of this rate in your swaps class. And let's say the day count convention that will be used is actual by 365. So the interest amount to be calculated will be 1 million into 4% into 2 divided by 365. Is this clear?
Yes,
Yes,
ma'am.
ma'am.
Okay, write down what is interbank lending.
Ma'am, what is the full form of SOFR?
Secured overnight financing rate.
Okay, ma'am.
Ma'am, is this example an example of notice money?
Yes, because it's borrowed for 2 days.
Got it.
Greater than a day, but less than equal to 14 days.
Got it. Thank you.
Ma'am, why would we borrow money on Friday and return it on Monday because Saturday, where they just have to maintain that money for Saturday and Sunday?
Saturday is a working day, no?
Okay,
For
ma'am.
banks, right?
Okay, ma'am. Ma'am, in that day count convention of actual upon actual, oh sorry, ma'am, 30 upon 365, what we take is every month, we assume every month has 30 days.
Yeah.
Okay, ma'am.
Thanks, Monica. So currently it's 4.5%. SLR you found out?
Yes, ma'am. Same percentage, ma'am.
18 only?
18 percentage.
Okay. Finish writing, folks?
No, ma'am.
Done now?
Yes,
1
ma'am.
minute, ma'am.
Yes, ma'am.
Okay. So next we're going to look at something called a certificate of deposits, which is usually again issued by banks, right? So you all know what are FDs, correct? Fixed deposits.
Yes, ma'am.
Yeah. What are your features of your fixed deposits? Let's first talk about the amount of deposit. How much money you can deposit to do an FD?
So according to the scheme, ma'am, in some schemes, we can start from 25,000.
Mhm. And then highest what you have seen
I guess.
5 CR.
in terms of money, like highest what? A lakh, 2 lakhs?
Ma'am, minimum is 10 rupees, maximum has no limit.
10 rupees as FD? I don't think you have 10 rupees as FD. You're talking about SIP maybe. I'm not talking about SIP. I'm talking about a fixed deposit.
Okay, ma'am.
Right? So Monica, you said minimum is 25, right? Maximum how much? It's a lakh, 2 lakhs maybe? A lakh?
Not sure.
Yes, ma'am,
Not
we
sure.
can do lakh,
A
5
lakh,
lakh FD
5
also.
One and
lakh,
a
I have
half
yeah.
lakh.
It can be
Yeah.
in
One
crores.
and a half lakh.
1.5, yeah. So, but then let's
It
talk
varies
about.
from bank to bank, ma'am.
Uh-huh. So let's say that, okay, the amount of deposits though usually in FD will be usually done by retail investors, correct? Retail investors like ordinary
ma'am.
individuals like you and me. Yeah.
Yes, ma'am.
Okay. Now, what is the other feature of an FD? The interest offered on them is not very much, right?
Yes, ma'am.
Yes, ma'am.
Yeah. Another thing is your FD, there's a maturity on it which you have to stick to. But if you break the FD before the maturity, you get penalized for it, right? Yeah.
Yes, ma'am.
Another thing is, let's say if you've taken an FD of 1 lakh, which is maturing in 3 months, and after a month, you need the money, and you go to your friend and say, give me 1 lakh, I'll transfer the FD in your name. Can you do that?
No, we have to break it.
No, you'll have to break. You cannot transfer it to someone else, correct?
Yes, ma'am.
Yeah. So those are your features of an FD. Now a COD, a certificate of deposit, is somewhat similar, but there are differences. First of all, the fund is same, you deposit money. But now the question is, who are the people who actually deposit money to do a COD? It is usually your high net worth individuals, large corporates, or institutions. Then you can imagine the amount of deposits won't be like 1 lakh, 2 lakhs. It will be a lot more, right? Yes or no?
Yes, ma'am.
Yeah. The interest offered on your CODs is also quite high compared to your fixed deposits. Now, your certificate of deposits can be broken before maturity, and sometimes penalties are not charged. Okay.
Okay, ma'am.
Sometimes penalties are not charged. Okay. It is transferable though. So let's say I did an FD worth 50 lakhs. I mean, I did a COD worth 50 lakhs with, let's say, SBI. Now, let's say the maturity is for 3 months. Now, after 2 months, I require the 50 lakhs. So let's say I go to Ajay and say, Ajay, you give me 50 lakhs, I'll transfer this COD to your name. Ajay will think, okay, because he's going to get interest on it, right?
Yes, ma'am.
Yeah.
Yes, ma'am.
So I can transfer the COD now to his name and I can take the 50 lakhs from him instead of breaking it and maybe incurring a small penalty charge or anything like that. Are we clear till here? So it's
Yes, ma'am.
transferable, right? The maturity on your certificate of deposits is anywhere from 30, 60, 90 days. It can even go up to 120, 180, even 365 days, but not more than 365 days. Is this clear?
Yes, ma'am.
So who are the investors in your CODs? Like I mentioned, your HNIs, institutions, and other banks. Are we clear with what's a certificate of deposit?
Yes, ma'am.
Yes, ma'am.
Write this down, please.
Ma'am, I just have a little question.
Yes.
What is the utility of certificate of deposits? Basically, are they a sort of guarantee that, like in lieu of them, we can get some amount?
You're getting an interest, no, on it.
In order to gain some interest, we
Yeah.
use the certificate of deposits.
In terms of this thing, as an investor, you might think, okay, let's say if you have 50 lakhs, you're thinking, okay, I don't want to invest in real estate. I don't want to invest in shares or money or bonds. I want to invest in a short-term instrument. Your
Okay,
best
ma'am.
safe bet is COD, right? Because it's a bank as well, correct? That is giving you a
Yes, ma'am.
COD.
Basically, for surplus money, we can use this in order to kind of get interest on the surplus money.
Basically, when you are an investor, your intention is to make more money, right?
Yes, ma'am.
So you will only make more money if you have surplus money, right? Now,
Yes,
if you're a salaried employee, you're not going to put your entire salary into savings, correct?
Yes,
Unless you
ma'am.
can do it, correct?
Yes,
You,
ma'am.
you have your other liabilities to take care of. So that means out of all of that, if you have a little surplus money, only you'll invest, correct?
Yes, ma'am.
Okay.
Okay, ma'am. Thank you.
Ma'am, certificate of deposit is a money market instrument which
Yes.
is having a maturity of less than 1 year.
Yes.
But
It's
some FDs like tax saving FDs are meant for 5 years.
yeah, that's the
It will
difference.
come
No,
under.
that's a difference. No, that's an FD. It's not a COD then.
Okay, ma'am. Then that FD will come under other.
Other this, it's a fixed deposit. It's not a money market instrument.
Okay.
Okay. No, Pragati, investment banks don't operate on weekends. It's only a 5-day work week. Yeah.
Okay, ma'am.
But there are shifts. You guys are aware of that, right?
No, ma'am, we don't know about this.
Didn't your salesperson who sold you the course tell you about the shifts?
No, ma'am.
We have to be flexible about the shifts. So now you're in your IB operations functions under 4 major shifts. You have something called as the APAC shift, which stands for Asia Pacific, which starts at about 5 in the morning and ends at 2 in the afternoon, right? Then
Okay.
you have your EMEA shift, which stands for Europe, Middle East, Africa, and UK shift, which starts at around 10 in the morning and ends at around 8 in the evening, right? And
Okay.
then you have your US shift, which starts at usually 4 in the evening and ends at around 1 or 2 in the morning. Okay.
Okay,
So
ma'am.
if you guys want to join IB operations, you have to be flexible on the shifts. Is this clear?
Yes, ma'am.
Yes,
Basically, it will be a 5-day week only.
5 day, no Saturday, Sunday working.
Okay, ma'am.
Okay. Right, finish writing certificate of deposit.
Yes, ma'am.
Okay.
Yes, ma'am.
The next item on the list is your commercial papers. Now, you remember we talked about zero coupon bonds in last class,
Yes, ma'am.
where we sold it at a discount and redeemed it at a par, right? The issuer sells it at a discount and redeems it at a par, and there's no coupon paid on it. Agreed?
Yes, ma'am.
Yeah. So your commercial paper is also similar. They're sold at a discount and redeemed at a par value. So to put it in example, let's say I'm an issuer who has a short-term deficit of 1 lakh, or not 1 lakh. Let me start speaking American decimal system because this is what is used in IBs. Let's say I have a short-term deficit or I want to borrow $1 million, right? So I issue something called as a commercial paper, which will have a par value, and you all know what is par value now, right?
Yes, ma'am.
Of 1.1 million. So when I sell this commercial paper to the investor, I don't take 1.1 million from the investor. I just take 1 million. Are we clear till here?
Yes, ma'am.
Yes,
So I've sold it at a discount. Let's say the maturity of this commercial paper is 30 days. So at the end of 30 days, when the investor comes to redeem the commercial paper from me, I don't return 1 million that he just gave me. I return 1.1 million. So his return is $100,000 in 30 days, which is not a bad investment, right?
Yes, ma'am.
Yeah. Is this clear to everyone?
Yes, ma'am.
What's a commercial paper? Now the maturity on commercial papers, it can be anywhere from 1 day up to or equal to 270 days. It can be greater than 270 days, less than 365 days. But here's the thing. If an issuer wants to issue a commercial paper that has a maturity of more than 270 days, then they have to get it registered at the securities regulator. Who is our securities regulator?
SEBI.
SEBI, exactly, right? Now then to get it registered at the regulator and all is additional cost, there's a lot of work and all involved. So usually your institutions who issue commercial papers for short-term borrowing usually issue commercial papers for less than 270 days maturity. Are we clear with this?
Yes, ma'am.
Yes, ma'am.
The par value usually starts with $100,000. You remember that sentence before we talked about disadvantage initial high investment?
Yes, ma'am.
Yeah. So this is, can 100,000 be affordable by everyone?
No, ma'am.
No, right? So that's what is meant by high initial investment as a disadvantage, right? On the
Yes.
plus side, though, the issuers who issue commercial papers are always high credit rated issuers, meaning the chances of default is very, very low.
Low.
Yeah. Your commercial papers are also unsecured, meaning they're not tied back to any asset. Is this clear?
Yes, ma'am.
Yes,
Okay.
ma'am.
Your commercial papers are also tradable, meaning, let's say if I'm the issuer, I issue a commercial paper worth 1.1 million, and let's say Christina buys this commercial paper, she pays me 1 million. Let's say the maturity is 30 days, right? Now she buys it for me, and let's say after 15 days, she sells it to Anupam at, let's say, 1,050,000. So Anupam buys it, but the next 15 days, when it comes to redeeming the commercial paper, how much does Anupam get? 1.1 million. Is this clear?
Yes, ma'am.
Yeah. So commercial papers are tradable in the secondary market, and people who buy and sell commercial papers are usually called as paper dealers. Is this clear?
Yes, ma'am.
Okay. And as mentioned, your issuers of commercial papers are usually your large institutions and companies that have a very good credit rating. Why do they issue it? They want to cover a short-term deficit of cash. Is this clear to everyone now?
Yes,
Yes,
ma'am.
ma'am.
Okay, write this down.
Yes, ma'am.
What is commercial paper?
Ma'am, can you please repeat this example, ma'am?
So, Pavitra, let's say I, as an issuer, have a short-term deficit of $1 million. So I decide to issue a commercial paper that has a par value of 1.1 million. Are we clear till here?
Yes, ma'am.
Okay, ma'am.
Now you buy this commercial paper from me, but you don't pay me the par value, which is 1.1. You just pay me 1 million. Is this clear?
Okay.
That is
Yes,
where
ma'am.
it's sold at a discount, meaning I sell it to you at a discount.
Yes,
Correct?
ma'am.
Now, after 30 days, when the commercial paper matures, I don't return 1 million that you originally gave me. I return 1.1 million. So your
Okay.
return is 100,000 on the commercial paper, right?
Yes, ma'am.
So basically, it's like a 10% return. Agreed?
Yes, ma'am.
Is this clear now?
Yeah, it's clear.
Okay.
Thank you.
Ma'am, basically in this we do not have any interest that we get. It is the profit that is basically the discount at which they are sold.
And the principal value at which it is redeemed. The difference between the par value and the discount price.
Okay, ma'am.
Deepti, you joined an hour later. Deepti, there. Done?
Yes, ma'am.
Everyone's done?
Yes, ma'am.
Okay. Yes, Satya, what's your question? Tradable one. Yeah, so if you buy the commercial paper from the issuer, you can sell it in the secondary market. So people buy and sell commercial papers in the secondary market. So it's called as tradable. Is this clear? Okay. So next money market instrument that we have is called as commercial paper. So what is a commercial, letter of credit. So letter of credit, you might have heard of this word in the news about a couple of years ago.
Nirav Modi took.
Yes, Nirav Modi, right?
Yes.
So let's talk about what is a letter of credit. So basically, letter of credit, to put it in context, let's say if I open up a business in Europe, right? Or let's say, instead of open up a business in Europe, let's say I want to import something from Europe. So I have to pay that person in euros, correct?
Yes, ma'am.
And the thing is, to borrow euros from my bank, it's a foreign currency. My bank might charge me a very high interest on it. Agreed?
Yes, ma'am.
Yes, ma'am.
Yeah. Now, my option is I can go to a European bank and say, hey, I want to borrow euros. But here's the thing. The European bank might hesitate to loan me the euros. A is I'm not a European citizen. I don't have, or rather, they cannot check my credit worthiness. And basically, they are not very, maybe thinking I'm not very secure in terms of returning the loan. Correct?
Yes,
Which is
ma'am.
a risk for them. Yeah.
Yes,
what
ma'am.
I can do then is go to my bank that I back home in India, and ask them to issue something called as a letter of credit, which would be given to that European bank as a guarantee, stating that this person who wants to borrow, let's say 1 million euros from you, you can loan them that euros. In case if this person defaults, I will step in and pay the remaining amount back or the full amount back, depending on this thing. Are we clear till here?
Yes, ma'am.
Yes, ma'am.
So now what happened in Nirav Modi's case was, he was into making high-end jewelry, so he wanted to buy precious stones from a European jeweler. So he took a loan from a European bank. He went to a European bank to get the loan, but they didn't give it. So they asked for a letter of credit. So he went to his bank, which is Punjab National Bank, and asked them to give a letter of credit. Now, the mistake that Punjab National Bank did was they didn't take any collateral. So in a letter of credit, for example, the example that I gave, 1 million euros, the equivalent of that in Indian rupees, let's say hypothetically 10 million Indian rupees, I have to give something worth 10 million Indian rupees as collateral to my Indian bank. Is this clear?
Yes, ma'am.
Yes, ma'am.
Okay. So only if that happens, then the bank should give a letter of credit. But in his case, what happened is he didn't give any collateral, but they still gave the letter of credit. Then when he defaulted and he couldn't pay the money back, now the foreign bank held who liable? Punjab National Bank. Why? Because they gave a letter of credit, right?
Yes, ma'am.
Is this clear?
Yes, ma'am.
Yes, ma'am.
Okay.
Yes, ma'am.
So what's a letter of credit or credit letter? Is a letter from the bank guaranteeing that the buyer's payment to the seller will be received on time and for the correct amount. In the event that the buyer is unable to make the payment on purchase, the bank will require to cover the full or the remaining amount of the purchase, right? So the letter of credit is a document sent from a bank or financial institute that guarantees the seller will receive his payment from the buyer on time and in full amount. Letter of credit is often used in international trading industries. Is this clear?
Yes, ma'am.
Yes, ma'am.
Okay.
Yes, ma'am.
Then we have something called as bills of exchange. So bills of
Ma'am?
exchange.
What is the
Excuse me, ma'am.
benefit for the bank?
Sorry, what?
What is the benefit for the bank for being guarantee for the the seller?
He would charge the seller, buyer something, no? You won't do it for free, right?
Okay, okay.
Right. Bill of exchange is also sort of like a letter of credit, but there's no middle person, there's no guarantor in it. To put it in a simple example, what is bill of exchange is, let's say if I buy something from Ajay, instead of paying him upfront, I write him a bill of exchange that says I promise to pay Ajay so and so amount on so and so date, etc. Is this clear?
Yes, ma'am.
Yes, ma'am.
So
Yes,
it's like
ma'am.
it's sort of like a promissory note, if you look at it. Is this clear?
Yes, ma'am.
Yes, ma'am.
Okay. So bill of exchange is a written order binding one party to another party to pay a fixed sum of money to another party on demand or at some point in the future. Right. So again, it's used usually in international trade to help importers and exporters to fulfill their transactions. Write this down.
Ma'am, actually, please one time explain letter of credit.
Letter of credit, Deepti, for example, is, let's say if I wanted to borrow a foreign currency from a foreign bank, let's say European euros from a European bank. That European bank might ask for a letter of credit from my bank. So let's say my bank is SBI. So let's say if I want to borrow 1 million euros, then SBI will give a letter of credit to the European bank saying that you can give this person 1 million euros. I will stand as a guarantor. So if that person defaults, I will step in and pay you the remaining money or the whole money. Is this clear?
Yes, ma'am.
Now, although for SBI to do that, I need to keep the equivalent amount of collateral at SBI as well. Is this clear? Then only they can issue a letter of credit. Done?
No, ma'am.
And what happens if you default the bill of exchange?
So that's the thing, no? If you default on a bill of exchange, you have kept the collateral at the guaranteeing bank, right?
All right.
They'll take the collateral and fulfill their bit.
All right.
So the problem that happened in Nirav Modi case was they didn't take the collateral, Punjab National Bank.
Got it.
Ma'am,
Yeah.
I have one question.
You
I
can
have
have more than one
heard
question.
one concept like if we can take a loan against the the uh, bill or order from the big companies. For example, if I have order of making 1000 cell phone, so I can take a loan against that order, something. Hello.
I'm not sure about that, Jay. I think that will be more related to commercial retail side. So never worked in commercial and retail side, so I'm not 100% sure what exactly that is.
Okay.
Right, can I continue?
Yes, ma'am.
1 minute, ma'am. Done, ma'am.
Everyone's done?
Yes,
Yes,
ma'am.
ma'am.
Okay. The next one we're going to talk about is repurchase agreement or repos, and you all might have heard of repo, right? Yes or no?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
You would have heard in the news, central bank or RBI has increased the repo rate, decreased the repo rate, or increased or decreased the reverse repo rate. Yeah.
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
So let's look at what is a repo agreement. So let me put it in an example. Let's say I want to borrow 1,000 rupees, right? And I go to Darren and I say, Darren, I want to borrow 1,000 rupees. Darren says, okay, I'll loan you the 1,000 rupees, but here's the thing. I don't trust that you will return the money to me on time or you may default. So I want some sort of collateral. Are we clear till here?
Yes, ma'am.
Yes, ma'am.
Okay.
Yes,
And
ma'am.
also Darren says, you want to borrow 1,000, but I want a collateral more than 1,000. Okay. So he says, I want 20% more than the amount of money that you're borrowing. So let's say I want to borrow 1,000. So now I have to give Darren collateral worth how much if he wants 20% more? 1,200, na?
Yes, ma'am.
Yes, ma'am.
Not so complicated. So I have to give Darren something worth 1,200. So let's say I give him my watch that is worth 1,200. So what technically happens here is I sell my watch to Darren and I borrow the money. And then at the end of the agreement, what do? I take my watch back or I buy my watch back and I return the money. Is this clear till here?
Yes, ma'am.
Yes, ma'am.
Okay. Now let's change the players in the agreement. Instead of me and Darren, let's put institutions, but primarily it is between banks. Okay. I'm a bank, Darren is a bank. Now I have a short-term deficit of money. What do? I sell some securities with the intention of buying it back, which is called as a repurchase agreement on my part. I'm the borrower. I sell some securities with the intention of buying it back. Are we clear till here?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
From Darren's part, who's a bank now, he has bought some securities with the intention that he's going to sell it back. He has bought some securities with the intention that he's going to sell it back. On his part, it's a reverse repo. Are we clear with this?
Yes, ma'am.
Yeah. So I, as a borrower, I sold some securities with the intention to buy it back. And Darren, as a lender, has bought some securities with the intention that he's going to sell it back. Are we all clear with what's a repo agreement and a reverse repo now?
Yes, ma'am.
Yes, ma'am.
Okay. So as I mentioned, let's say I want to borrow $1 million. So I'm a bank. I go to another bank. We enter into my part, it's a repo agreement. His part, it's a reverse repo agreement. The lending bank demands something called as a haircut, which is a percentage by which the security is over collateralized by the borrower. So let's say the lending bank demands a 20% haircut. Then I, as the borrower, give bonds. Let's say you all know what are bonds now, right?
Yes, ma'am.
Yeah?
Yes, sir.
I give bonds that are worth 1.2 million to the lender. Now, at the end of the repo agreement, I buy back those bonds and I return the money back to the lender. Is this clear?
Yes, ma'am.
Okay.
Yes, sir.
Now, why does the lender take securities as collateral? Why? Guys, why does a lender take securities as collateral?
As a method of security,
Yes, why? So, in case if
the
the
borrower
borrower
makes
defaults,
he can
he-
sell it back and get his
Exactly.
money back.
Yeah, exactly. So if the borrower defaults, the lender, only if the borrower defaults, the lender is within his rights to sell the securities in the market and recover the money. Is this clear?
Yes, ma'am.
Okay.
Yes, ma'am.
What is the interest that the lender receives? The lender receives the difference on the amount at which he bought the securities for which he sold. Now, will he buy it at a lower rate and sell it at a higher rate, or vice versa? Lender, to be specific.
Buy it at a lower rate and sell it at a higher rate.
Correct. The difference would be the interest that he would have earned. Correct.
Yes,
Yes,
ma'am.
ma'am.
Is this clear to everyone?
Yes, ma'am.
Yes, ma'am.
Okay. Repos are secured. Why? Because they are tied to a collateral, which are securities. So in case if the borrower defaults, the lender can sell the securities in the market and recover the money. Yeah. There are also bilateral agreements, meaning there's no secondary market. So to put it in context, that part where I talked about me and Darren now being banks, and I've done a repo agreement and he's done a reverse repo agreement. Tomorrow, I cannot try to step out of that repo agreement and ask Christina to take over, nor can Darren step out of the agreement and ask Ajay to take over. It's an agreement just between the two of us or two banks. Is this clear?
Yes, sir.
Yes,
Okay.
ma'am.
Now, in terms of maturity, you have something called as your open repo and something called as term repo. So open repo has a maturity of only 1 day, and term repo only has a maturity between greater than 1 day up to 365 days. It will be a number of days to be exact. Sorry, just give me a second. Is this clear?
Yes, ma'am.
Yes,
Okay.
ma'am.
Now, collateral satya meaning any sort of instrument or tangible securities or untangible also it can be that has a value that you give, right? For example, like we said in the home loan, you took a loan of money. What is the collateral you give is the house, right?
Yes, ma'am.
Is this clear now, Satya?
Ma'am means when he will come back to the borrower, he will also give him 20%.
No, that will depend. What is the interest that the lender is charging on the repo?
Okay.
Okay. Haircut is different from the interest that is charged. Are we clear?
Yes, ma'am.
Okay. Now, repo agreements are done between banks. Having said that, your central banks enter into repo agreements with your other banks. Other banks meaning your like private or even your public banks. Why?
Ma'am, to reduce the
Repeat the
inflation,
question.
yes, usually
Sorry, what was that, Nalina?
to reduce the inflation and to keep banks in check, they do that.
Very good. So RBI is the monetary regulator. That means his primary job is to ensure that there are proper cash flow of rupees in the market, correct?
Yes, ma'am.
If there is excessive rupees in the market, that's going to reduce the value of the rupee, which would then lead to inflation, correct?
Yes, ma'am.
Yeah. If there is low supply of money in the market, then the value might go too high, which would then also cause problems, correct?
Yes, ma'am.
Yes, ma'am.
Yeah. To give you a very classic example, couple of years ago, our country underwent a huge thing called as demonetization, right?
Yes,
Yes,
ma'am.
ma'am.
That time everyone started depositing more and more money in the banks, correct? At that point of time, the central bank also increased your cash reserve ratio and statutory liquidity ratio as well, right? So
Yes.
central bank would enter into a repo agreement, meaning it would act as a borrower if there is excessive cash in the market, right? And if there is less cash in the market, it will do reverse repo, meaning it will act as a lender. Is this clear to everyone?
Yes, ma'am.
Yes, ma'am.
Yeah. So write this down.
Ma'am, can you please explain haircut again?
Sure. Haircut is a percentage by which you over collateralize. So to put it in context, if you wanted to borrow 1,000 rupees, Sonali, okay, I won't take anything that is just worth 1,000 rupees from you. I want something that is of more value. Are we clear till here?
Okay, ma'am.
Okay, so let's say I wanted 20% haircut. That means you have to give me something worth 1,200.
Okay, I got it, ma'am.
Got it?
Yes, ma'am.
Ma'am, is it always compulsory that the value of collateral that they will take will has to have a haircut?
Yes.
Okay, it is compulsory. Okay,
Yep.
ma'am. And ma'am, what if the borrower doesn't default? Then what is the profit to the lender in that case?
He charges him an interest on the money that he's borrowed, no?
Okay, ma'am. Okay.
Like I said, don't confuse haircut with the interest that the lender charges. Understand that?
That means he will return the haircut person.
No. Again, let me put it an example. You want to borrow 1,000. I say haircut is 20%. So let's say you give me something. Let's say you give me a watch worth 1,200. Are we clear till here?
Yes, ma'am.
Okay. Now, when I return the watch to you, that means we are ending the repo agreement. You not only return the 1,000, let's say I charge you an interest of 10%. So you'll pay me 1,100. Is this clear?
Okay, ma'am. Yes.
So that 100 rupees will be the interest that I've charged you. Is this clear now? So don't confuse haircut with the repo interest.
Basically both are compulsory. Interest is something that has to come, and haircut is something that he will demand of, like the security has to be greater than that amount.
Exactly.
That is what.
Okay. Although in repo agreements, because it's primarily done between banks, the over collateralization may not be always there. So they may not always ask for a haircut.
Okay, ma'am.
Okay.
Ma'am, so basically in your example, 1,100 will be paid and 1,200 worth thing will be again taken back.
Yes, exactly.
Okay, okay.
Ma'am,
Hi. Go ahead.
Haircut percentage is fixed or depends upon the amount, ma'am?
Haircut will depend on the credit rating of the borrower.
Okay, ma'am.
Done?
No, ma'am.
Okay. Let's do one thing. It's close to break time as well. So finish writing this. Is everyone back?
Yes, ma'am.
Can we
Yes,
continue?
madam.
Yes,
Yes,
ma'am.
ma'am.
Okay, so the last instrument that we're going to talk in the money markets is treasury bills. Have you heard of this term, treasury bills?
Yes, ma'am.
Excuse me, ma'am.
Yes.
A small doubt, ma'am. Can you please explain the fourth and fifth point in short again?
These points.
Yes, ma'am.
Bilateral agreement and RBI publishes repo rate.
Yes, ma'am.
Okay, so bilateral agreement means, let's say if I enter into a repo agreement and you enter into a reverse repo agreement with me, tomorrow I cannot step out of the agreement and ask someone else to take over, or you also cannot step out of the agreement and ask someone to take over, right?
Oh,
so
okay.
it's just an agreement between the two of us. Is this clear?
Yes, ma'am.
So that would entail that it's not transferable, or nor does it have a secondary market, meaning it cannot be tradable in the market. Okay.
Okay, ma'am.
So fifth point is RBI, central banks publish repo rate and reverse repo rate. Na? So that is in case if they act as a lender or borrower, what is the rate they're expecting for the repo agreement? Okay, not the haircut, the interest that they will charge.
I got it, ma'am. Thank you.
No problem. Right. So on to treasury bills. So treasury bills are also like your zero coupon bonds. They are sold at a discount and they're redeemed at a par value. And your treasury bills are usually issued by government or government related bodies. Now, why would a government or government related body want to borrow short-term cash? Any idea?
To deficit their financing.
One is they might have a deficit, but primary reason why they would issue treasury bills is to fund a project like building highways, schools. Lately it's metros everywhere. Yeah.
Ma'am. Yes, ma'am.
Okay. And also they might issue treasury bills to pay back the maturing treasury bills. So mature, as we know, your money market instruments have short-term maturity, right? So when a treasury bills are maturing, they have to pay back the investors the money, correct?
Yes, ma'am.
Yeah.
Yes, ma'am.
So
Yes, ma'am.
see how smart they are. Instead of dipping into their reserves, they'll just take the capital from the public, pay back the capital from people whose treasury bills are maturing, right? Now, some of your other features of your treasury bill is, this is the money market instrument that is affordable by everyone. Even your retail investors can invest in it because the denomination usually starts as low as 1,000. Is this clear?
Yes, ma'am.
Okay. So treasury bills have a maturity of 30 days, 60 days, 90 days, 120 days, and they're tradable, meaning they can be sold in the secondary market. Are we all clear to here?
Yes, ma'am.
Yes, ma'am.
Okay, so write these features down and we'll talk about how your treasury bills are sold by the government to the public, which is called as a treasury bill auction. And we'll be talking more in retrospect of your US market, because treasury bills is commonly sold in the US market by the US government. And we'll talk about how the auction is done, and we'll run an auction in class where you guys will act as the investors and you'll give me bids like how we did on the IPO. Okay.
Okay, ma'am.
Ma'am, are T-bills unsecured?
Yes, they're not tied back to any asset because they're issued by the government, right?
Yep. All right.
Finished?
Yes, ma'am.
Yes, ma'am.
Okay. Now I
Ma'am?
want,
Ma'am, can you repeat once again treasury bills, ma'am? Actually, I had lost my connection.
so treasury bills are money market instruments that are issued by government or government related bodies, and they function like your zero coupon bond, meaning they're sold at a discount and they're redeemed at a par value. The reason why governments issue treasury bills is to fund a short-term project like building highways, schools, etc., or to pay back maturing treasury bills, right? The par value usually if a treasury bill starts with as low as 1,000, so it's affordable by your retail investors as well, right? The maturity is anywhere between 30 days, 60 days, 90 days, and 120 days. And your treasury bills have a secondary market, meaning you can buy from the government directly and then you can sell it to another investor in the secondary market. Is this
Okay,
clear?
ma'am. Okay, ma'am.
Okay, so let's take, oh, part is missing here. Let me write it down a little later as I'm explaining. So let's say government announces it's looking to raise this much money. How much money is this?
10 billion.
10 billion, $10 billion. Yes, right. So it's looking to raise about $10 billion. So let's say if they're going to keep the par value of the treasury bill as 1,000, that means they're looking to issue 10 million treasury bills. Is this clear?
Yes, ma'am.
Okay. Now, when you bid on treasury bills, you can fall under something called as a competitive bidder and something called as a non-competitive bidder. So if you're a non-competitive bidder, you're usually a retail investor, meaning an ordinary individual like you and me. Is this clear?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Okay. As a non-competitive bidder, you can or you will submit the number of treasury bills you want to buy, not the price, just the number of treasury bills. Is this clear? Is this clear to everyone?
Yes,
Yes,
ma'am.
ma'am.
Okay. Now on the other side, you can be a competitive bidder. So competitive bidder, usually it's institutions, banks, other governments, HNIs, etc. They bid competitively. When they bid competitively, what does this mean is they submit not only the quantity of treasury bills they want to buy, but at what price they want to buy the treasury bill at. Is this clear to everyone?
Yes, ma'am.
Okay. In actuality, they actually submit the yield they are expecting on the treasury bill. You remember what is yield?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
What is yield?
The
The
percentage of
percentage return.
A percentage return on this thing. So,
Investment.
owing to the fact that they submit in terms of yield, competitive bidders would submit in a higher yield or lower yield on the treasury bill.
higher yield.
Higher yield.
Higher yield. Everyone agrees with higher yield?
No, ma'am, I think lower
I
yield.
think lower yield.
Lower yield is right. Why? Because if you submit a higher yield, that means per treasury bill you are willing to pay a lower rate. Then the government would not give you the treasury bill, right? Because the purpose why they're issuing the treasury bill is they want to raise that short-term fund. Agreed?
Yes, ma'am.
Okay. So they'll submit in a lower yield. Is this clear?
Yes, ma'am.
Yes,
Okay.
ma'am.
Now, to make it more understandable for the explanation of the auction, we will consider price. Okay. All you have to remember, higher the price, lower the yield, lower the price, higher the yield. Is this clear to everyone?
Yes,
Yes,
ma'am.
ma'am.
Okay. And as in your book building in your IPO, the government also gives a floor and cap, right? So the maximum you can pay is 990. The minimum or floor price you can pay is, let's say, 900. Or 900 is too much. Let's make it 980. So when you bid as a competitive bidder, you can bid for the quantity and at price of anywhere between 980 to 990. Is this clear?
Yes, ma'am.
Yes.
Why not 999?
Ma'am, because 1000 is the
Exactly, right? 1000 is the par value. If you're getting a $1 return as an investor, would you want to invest in a treasury bill then?
no, ma'am.
No, exactly, right? Now, we discussed that your non-competitive bidders can only bid on the quantity of treasury bills they want to buy. So sometimes in a treasury bill auction, not sometimes, usually on a treasury bill auction, the government will set a cap on the number of quantities of treasury bill a non-competitive bidder can buy. So for example, the issue size is 10 million here, right?
Yes, ma'am.
Yeah. So let's say the cap for non-competitive bidders is 5,000 treasury bills. That would mean as a non-competitive bidder, you can bid for one treasury bill up to 5,000 treasury bills, not more than that. Is this clear?
Yes, ma'am.
Okay. Sometimes for your competitive bidders also, they might set a cap, but not required. So the non-competitive bidders can bid on how much quantity they want at what price they want. Is this clear till here?
Yes, ma'am.
Okay. Once you decide whether you're a competitive or a non-competitive bidder, you submit your bids on something called as TAPS, which stands for Treasury Auction Automated Payment System. So as a non-competitive bidder, you would just put in the quantity of treasury bills you want to buy. As a competitive bidder, you put in the quantity and the price at which you want to buy the treasury bills. Are we all clear till here?
Yes, ma'am.
Yes, ma'am.
Okay, so write this bid down, then we'll run an auction in class. So don't start yelling out your bids. So you can decide to be either a competitive or non-competitive bidder. So I'll ask each of you your bids. Now, if you're bidding non-competitively, you can just give me the quantity of treasury bills you want to buy, and the cap is set at 5,000 treasury bills. You can't buy more than that, right? If you want to bid competitively, you have to give me the quantity and at what price you want to buy. Is this clear?
Yes, ma'am.
Yes,
Okay,
ma'am.
so write these points down, then we'll start the auction. Again, don't scribble down your bids yet, or don't tell me your bids yet. I'll ask you guys individually. Yeah.
Okay, ma'am.
Ma'am,
Yes.
Ma'am, there is no like maximum quantity of T-bills for competitive bidders. No, ma'am, they can bid as much as they want.
Yes, sometimes the government can put a cap, but usually they don't.
Okay, and they have that right to determine the price and the quantity they require, but which is not available in case for non-competitive bidding.
Exactly.
Or
For
is it?
non-competitive bidding, they can only bid on the quantity of treasury.
And for competitive, quantity as well as price.
Yes.
Okay, ma'am.
Finish writing?
Ma'am, I had a question.
Mm-hmm.
Was there any instance where a competitive bidder bought all the T-bills that were available in the market?
That wouldn't, there can be a possibility that they can buy the entire this thing, but then the government wouldn't give the entire lot to just one person. They'd allocate pro rata, like how we
Right.
discussed in IPO.
Yeah, got it.
Done?
Yes, ma'am.
Okay.
Yes, ma'am.
Therein the specific difference we discussed, no, competitive bidders are usually your larger institutions and they get to bid on the quantity and price, whereas your non-competitive is usually your retail customers who can only bid on the quantity of treasury bills, right? So let's start the bidding. Ajay, do you want to bid competitively or non-competitively?
I'm competitive bidding.
Okay, how many treasury bills and at what price?
50,000 treasury bill at the rate of 990.
990. Okay. Anupam?
Ma'am, competitive.
Okay, how much?
Ma'am, 50K at 981.
50K at 981. Okay. Just give me a second, for some reason it's coming in bold. Right. Ashwini?
39,985.
39,000 at
985.
985. Okay. Darren? 90,000 at 980, 990. Okay. Deepika? Deepika, are you there? Right. Vijendra? 100,000 at 450. 100,000 at 500. No, it's 980 to 990. Change your price. Ganla Vijendra. Sorry, did I pronounce that right? Deepika, what's the price you want? 995. Okay, 995 is not possible because I'll put it as 990 because the cap was 990, right? 49,999 at 890, not at 890. You have to bid between 980 and 999. Hang on, guys. Stop writing in between who I'm asking them only, please. As of now, 49,999. What's the price, Vijendra? $990. Okay. Right. Ritik, you're up next. Ritik, you there? Jay?
Ma'am, 1 lakh for 987.
Okay. 100,000
तुम्हाला नाही
at 987. And Ritik also gave his this thing, same bid as Vijendra. Okay. Right. So Joycelana. 250 at 989. Okay, Sarita, wait. And by the way, I need your email ID and phone number, Sarita. Write that down as well. Kritika, you're up next. Kritika, wait. Kritika, I asked, right? So Kritika, you're saying 40,000 for 985. Okay, Leka, 40,000 at 980. Okay, Monica. Monica R.
Non-competitive bidding 5,000, ma'am.
Non-competitive. Finally, someone's opened up the non-competitive. 5,000. Non-competitive. Okay. Monica. Non-competitive. Non-competitive, you cannot give me the price. You can only give me the quantity, Monica. So shall I write the quantity down? Yeah. So that is 3,850. Okay. Right. Alina?
Ma'am, 3 million at 989.
Oh, someone's talking now. 3 million at 989. I'm not going to take actual money from you folks. Okay. Nandini, you're up next. Let's see here. 1 million at 986. 986. Okay. Nikhil? Nikhil, you're up next. Okay, Nikhil might be this thing. Nitish? Non-competitive 5,000. Okay. Pavitra? Non-competitive 4, 5, 6, 7. Pragati?
I'm non-competitive 5,000.
Non-competitive 5,000. Okay. Rishita?
Non-competitive 4,000.
4,000. Ritika, you can tell me now. What was your bid? 200,000 at 988. Okay, Sarita, what was it you mentioned? Sorry, can you mention it again, Sarita? I lost it somewhere in the listing. Sarita, your bid again, please. Kill, okay, 180,000. 180,000 at 1,000, no. It's between 980 and 990. Right. Where did you Satya? You're up next. Nikhil, change the price. I'll put the price on your behalf.
85,000 at 983.
85,000 at, sorry, what was that?
983.
983. Okay. Shivam?
Ma'am, non-competitive 5,000.
Non-competitive 5,000. Okay. Shivangi? $80,000 at 970. Okay. Right. Shreyas? Shreyas, you there? Okay. What was that? 999,995. Okay. So before that, let me just put Sarita's bid here. Okay, 999,000 at 975. Between 980 and 990. Give me the price again. Shreyas. 984. Okay. Simple. 500,000 at 986. Shivangi is also given. Okay, 160 at 950 is not possible. 980 to 990. Shivangi. Change the price. Sneh Buna. Babna, sorry. Sneh Babna.
Not non-competitive 4,500.
4,500 on non-competitive. Okay. Sneha Singh. Non-competitive 3,456. Okay. Sonali?
4 million for 990.
4 million for 990.
Ma'am, sorry for interrupting.
Yeah, tell me.
Ma'am, on the 33rd tab, my 33rd line, how's that 80,970, ma'am?
Oh, good. Thanks for catching that. Let me just change that. I'll make it a random this thing. 984.5. Okay, just give me a second, folks. Okay, where were we? We stopped at Sonali, right? Shrishti, you're up next.
Non-competitive 10,000.
10 nahi. It can be 5 maximum.
Okay, then 3,600.
3,600. Okay. Tanu?
5 million at 985.
5 million at 985. Okay. Yamuna? 4,444. Yashraj?
Ma'am, 3 million and 988.
3 million at 988. Okay. So here, let's see. This auction is oversubscribed, but first of all, these smaller bids of 50,000 and all will get rejected. Okay, is this clear? Because owing to the fact that your competitive bidders are these guys, they'll bid on huge chunks of treasury bills. Is this clear till here?
Yes, ma'am.
Yes, ma'am.
Okay. Now, who bid non-competitively, congratulations, you'll get the treasury bills. But the question is, what price will you pay for these treasury bills? Yeah.
Yes, ma'am.
Because you don't know what is the price that will be paid, correct?
Yes, ma'am.
Yeah. So it has come up to 50. So first of all, the government will tally up how much is the quantity in terms of non-competitive bidding, right? So it's tallied up to 52,417, right? So I'll just add another bid to round it off. So let's say 583. Okay, so it rounds up to 53,000. Now, what the government will do is, out of the 10 million treasury bills, 53K treasury bills, meaning 53,000 treasury bills, is set aside for the non-competitive bidders. Is this clear?
Yes, ma'am. Okay, ma'am.
Okay. So the remaining out of the 10 million will become how much? 9,947,000 treasury bills will remain for the competitive bidders. Is this clear till here?
Yes, ma'am.
Yes, ma'am.
Now, again, in your treasury bill auction, you have the allocation called as discriminatory and uniform. You remember we did this in your IPO?
Yes, ma'am.
Okay.
Yes, ma'am.
So let's say they're going to do discriminatory. Again, they'll work as per the highest quantity and highest corresponding price. Okay. So highest quantity here is 5 million. This person will get the treasury bills and pays 985. Is this clear?
Yes, ma'am.
Yeah. Then this person will get pays 990, right?
Yes, ma'am.
Then 900 and how much is remaining? 947,000 treasury bills are remaining. Who is the next highest? So you have 3 million and 988. We have 3 million and 989. So this person will get it next, right?
Yes, ma'am.
Is this clear? So now, because the auction is oversubscribed, instead of giving it to just these 3 people, what they'll do? They'll give pro rata basis. You remember what is pro rata basis, right?
Yes,
Yes,
ma'am.
ma'am.
Yeah. So let's say instead of getting this entire 5 million, this one might get maybe 1 million, pays 985, and then it goes down the list. Are we all clear with what is the way in discriminatory pricing?
Yes, ma'am.
Okay. Hypothetically, let's say hypothetically they're doing it on a pro rata basis, and this is the last allocated bid. Last allocated bid meaning the last person to get the treasury bills. Is this clear?
Yes, ma'am.
Yes, ma'am.
The corresponding price to it is called as stop price. This is the price that the non-competitive bidders will pay. I'm going to repeat it. Once the non-competitive bid treasury bills are tallied, that is set aside from the issue size, the remaining treasury bills are allocated to the competitive bidders. And if they do discriminatory pricing, they allocate as per the highest quantity and highest corresponding price. Now, if the auction is oversubscribed, they'll distribute the treasury bills or allocate the treasury bills on a pro rata basis. Once all the treasury bills are allocated to the competitive bidders, whichever is the last allocated bid, the corresponding price is called as stop price. And that is the price that the non-competitive bidders will pay. In this case, it became 985. If let's say hypothetically the last allocated bid was this, then this becomes the stop price which the non-competitive bidders would pay. Is this clear to everyone?
Yes, ma'am.
Yeah.
Yes, ma'am.
So write down what is your discriminatory pricing under your treasury bills. Then we'll talk about the uniform one.
Ma'am, but we had kind of kept $5,000 for this. No, then how can we?
Not $5,000, quantity 5,000.
But then we have allotted 53,000 shares.
This is the total of how many.
Okay, that was the maximum one bidder can take.
Yes, that's
Okay, ma'am.
okay.
Okay, ma'am.
So IBP అనుకుంటా యాప్ ఉందేమో నాకు తెలియదు నేనైతే
Ma'am, one more doubt. How will we cancel out the lower bids? Like, what will be the criteria that below this bid are all lower bids and they will be cancelled?
Usually it is the quantity. So these small quantities they'll reject.
Like small till where? Like above one
It
lakh?
depends on the government's this thing.
Okay, ma'am. Okay. And ma'am, one more question. Can a person be both a competitive bidder and a non-competitive bidder?
It depends on how desperate you want the treasury bills.
Okay, ma'am. But we
Right.
can be both in certain
You
cases.
can be both. The difference is if you're bidding competitively, you put in the quantity and price. If you're bidding non-competitively, only quantity, but there's a cap.
Okay, ma'am.
ma'am. Ma'am,
Yes.
ma'am, the quantity is like 40,000 of two bits. Why did we choose only 995 price as stock?
Like I said, Pavitra, assuming that this was the last allocated bid.
Okay, ma'am. Thank you.
Okay, I gave an example. We didn't actually allocate, right?
Okay.
All. So Karen's question is person switch immediately from competitive to non-competitive. At the same time, you can put your bid, na? Okay.
Ma'am, in this case, the non-competitive bidding case, if we had much more, like more number of subscribers trying to bid on this non-competitive, but will all of them get the number of allotted shares
No, they'll also get then a pro rata basis.
if it is oversubscribed?
Yeah, if it is oversubscribed.
Okay, ma'am. And basically, in this method, we use only the discriminatory method. We do not use the uniform pricing method.
I'm going to explain uniform as well. I just explained discriminatory.
Okay,
and
this was
let you-
discriminatory method.
Yes, this was
Okay, ma'am.
discriminatory.
Okay, ma'am.
Done?
Ma'am, just a minute.
Sure.
Ma'am, what is this average 986 stands for here?
I haven't explained it yet. Don't write that down yet.
Okay, ma'am.
Ma'am,
Yeah.
ma'am, in case of oversubscription, pro rata basis will be used, and in case of undersubscription, everybody will get the
Treasury bills. Finish writing?
Yes, ma'am.
Everyone's done?
Yes, ma'am.
Yes, ma'am. So now you can have it with uniform pricing. So when the government is actually doing the auction, they will mention if they're going to do uniform pricing or discriminatory pricing. Okay. So we just discussed discriminatory pricing. If it is uniform pricing, how will it work? Is again like how we did it in IPO. We'll see the number of bids collected, right? So the number of bids that are collected was 23. So bottom 25% of 23 bids, which will be 6 bids in terms of the least quantity and corresponding price, the price gets cut off, right? The price gets cut off. The remaining prices are added and averaged. Is this clear? So what I've highlighted in red are your bottom in terms of least quantity and least corresponding price. The average then for the remaining one turns out as 987. Now this is the price that everyone will pay, both the competitive and the non-competitive bidder. So for example, this first person who's bid for 5 million, now again if they're going to do pro rata basis, maybe would get just 1 million shares, but instead of paying 985, will have to pay 987. Is this clear?
Yes, ma'am.
Ma'am,
Again.
could you please repeat?
Okay, pay attention. If the government is going to do uniform pricing, it will cut off the bottom 25% of the number of bids they've collected in terms of the least quantity and least corresponding price. They've collected 23 bids here, right? So 25% of 23 is approximately 6 bids. So 6 bids in terms of the least quantity and least corresponding price. The first least quantity is 39,000. The corresponding price is cut off and so forth for the other ones. The remaining prices are added and averaged, and that average price in this example turns out to be 987. Okay, 987.29 something approximately.
Okay, ma'am.
Okay, this is the price that everyone will pay now, both the competitive bidders and the non-competitive bidders. Clear?
Excuse me, ma'am.
Yes.
This 24 through 9,999 won't be selected.
No, because the thing is, you already cut off and both of them are at the same price, right?
Okay, so we'll.
Anyone you can cut off.
Okay.
Okay.
Yes, ma'am.
If it was, let's say, if this was at 990 and this was at, let's say, 987, then this one would have gotten cut off the price.
Not both of them.
No. And the quantity is same, right?
No, that is okay, but it is less than.
Not both of them. In this, like for example, in this, we have two 40,000s, right? Which is the least price in that 980. That gets cut off.
Yes,
Is this clear?
No, ma'am. Okay.
Ma'am, so in discriminatory pricing, 985 will be the price, and in this uniform, 987.
Nay, Sonali, pay
Then-
attention. In discriminatory price, everyone pays what price they bid at. Is this clear?
Okay.
The question is, what will the non-competitive bidders pay if it is discriminatory pricing? Because they don't submit a price, right?
Okay, so only for non-competitors, it is 985.
Which will be the, in this example, 985, because we've assumed the last allocated bid is this and the corresponding price is this.
Okay, ma'am.
If
Okay.
the last allocated bid was this, then 989 would be the price that these guys would pay. Is this
Yes.
clear?
Yes, ma'am.
Okay. Uniform pricing, it doesn't matter. Both the competitive and non-competitive bidders pay that uniform price. Is this clear now?
Yes, ma'am.
Okay. Let me know once you finish writing. Done?
No, ma'am.
No, ma'am.
Yes, ma'am.
Done now? Guys, done? Yes or no?
Yes, ma'am.
Okay.
Yes, ma'am.
Sure. Done now?
Yes, ma'am.
Yes,
Okay.
ma'am.
So remember the stock price we talked about?
Yes, ma'am.
Yes, ma'am.
The corresponding yield to it would be called as stop yield. So if you have to calculate the stop yield for this, what will be the calculation? Yes. Remember we calculated current yield, you remember?
Yes,
Stop
ma'am.
price divided by.
Not stock price, it will be the coupon amount. In this case, there is no coupon, so the difference would be the par minus the price. So 1000 minus 985 makes it how much?
15.
15. 15 divided by 1000, which is the par, right? Yes or no?
Ma'am.
Roughly about 1.50%. Is this clear? This will
Yes,
become
ma'am.
the stop yield. Are we all clear with this?
Yes, ma'am.
Okay.
Ma'am,
So if you have to calculate the stop yield, if the stop price is 985, how will we calculate the stop yield? It will be 15, which is the difference between 1000 and 985, which is basically your coupon, right? Yes or no?
yes, ma'am.
Divided by 1000, which is the par value of the treasury bill. Is this clear?
Oh.
Into 100 to give you a
Yes, ma'am.
percentage.
Okay, ma'am.
Is this clear to everyone?
Yes, ma'am.
Yes, ma'am.
Okay. So this becomes the stop yield now for this, right? If you want to calculate the yield on this one, how much will it be?
1%.
1%, exactly. Right, which is 10 divided by 1000 into 100. Is this clear?
Yes, ma'am.
Okay, right. Now, one more thing left, or rather one more point to be made on the treasury bills. If your treasury bill auction is oversubscribed, it's called as a short tail auction. I'm going to repeat it. So just give me a second. If your treasury bill auction is oversubscribed, it's called as a short tail auction. If it is undersubscribed, it's called as a long tail auction. Is this clear?
Yes, ma'am.
Okay, so I'll write it down here. Oversubscribed. And you all know what is oversubscribed, right?
Yes, ma'am.
Undersubscribed called as long tail auction. Okay, write this down. Let me know once you're done.
Ma'am, why it is called short tail auction and long tail auction? The
That's the
significance.
terminology they've given. That's it.
Okay.
Okay, it's based on calculation. Actually, it's the based on the number of bids collected divided by the number of bids accepted. So that ratio would tell you how many people are bidding for a treasury bill. So if it's like a 5:1 ratio, meaning there are 5 bids for one treasury bill, would that make it a short tail or long tail, or oversubscribed or undersubscribed?
Maybe oversubscribed.
Oversubscribed, because there are 5 people bidding for one treasury bill, right?
Yes, ma'am.
Yeah. If the ratio was the other way around, 1:5, that means one person is bidding on 5 treasury bills, it would be an undersubscribed auction, meaning a long tail auction. Yeah.
Okay.
Ma'am, what does 1.5% in relation to stop yield determine or define as?
Array Sonali, to put it in basic this thing, we said this, we assume this is the stop price, right?
Yes, ma'am.
We said that usually your treasury bills, whenever the bid is done, they submit the yield they want, correct?
Yes, ma'am.
So in this case, I just wanted to tell you what would be the stop yield.
Okay, got it, ma'am.
Okay, if I have to calculate the yield on all of this, it would be what? 1000 minus these prices divided by 1000 to give you the yield on all of these bids.
Okay, ma'am, I got it.
Done?
Yes, ma'am.
So that winds up your money markets class, not a very big class. So this is what you all covered in the Excel sheet, right? So here are questions for this topic, not many questions also. What is money market? What is the advantages and disadvantages of money market? What are your money market instruments and features? How are treasury bills auctioned? And what's the difference between capital markets and money markets? Okay. Right. Someone had some doubts from the financial systems class? You can sort that out now if you like. Am I audible, folks?
Yes, ma'am.
Okay, someone had a doubt, right?
Yeah, ma'am. Ma'am, I have a doubt in code-driven market and order-driven market. Actually, I have attended a quiz and only questions related to code-driven market and order-driven market has been wrong. So I wanted a clarification on both the topics.
So your order-driven market is the exchange-traded market, right?
Exchange-traded market. Okay, ma'am.
So there we don't know the counterparty, the price is transparent. Okay. The order execution is not guaranteed because the exchange has to find us a seller or a buyer. Is this clear till here?
Yeah, ma'am.
The order settlement is guaranteed because we maintain margins at the clearing house.
Okay,
so hypothetically, if the buyer or seller defaults, then the clearing house will step in and do novation, where it will act as a seller to a buyer or buyer to a seller. Okay, so the default risk is very low on the exchange traded market or order driven market. Okay. The other side is your code driven market, which is also called as
any example for order-driven market?
any of your stock exchanges.
Okay. NSE, BSE, and NASDAQ.
NASDAQ, NYSE, LSE, HSE, HKSE,
It's
anything.
an example of order-driven market.
Order driven market, yeah.
1 minute, ma'am, to write it. Yes, ma'am.
Yeah. And your code driven market, which is also called as over the counter market or OTC market, is where you know who your seller or buyer is because you know them. Okay.
Okay, ma'am.
So price is not transparent. The reason being because you know your counterparty, you can negotiate on the prices, right?
Okay.
Okay. So your order execution is guaranteed because if one person doesn't agree to your price, he's not the only seller or buyer in the market. There are many people who you know who buy and sell. You can approach them and then someone or the other would agree to match you on your price, right?
Okay.
But the settlement is not guaranteed because in the OTC market, your clearing house doesn't play a picture. So we don't maintain margins in the clearing house for OTC market. So your default risk is high. So in case if there's a default now, the clearing house will not do novation. Okay.
Okay.
Right.
Then an example of code-driven market is?
You can use Bloomberg terminals or Reuters terminals, which will cover in when we do
Yeah,
your OTC trade life cycle. Yeah.
Okay. Thank you.
One second. Yeah, you're welcome. Satya, yeah, take a note what you wanted to take down. Pragati, you had a question. Ma'am, the system calculation based, yes, it is automatic because there will be, like you said, innumerable number of bidders, right? It's okay, Satya wanted the theory side. This is all what we covered in the Excel sheet only, Satya. Is this the part you wanted to see or further down? Okay. Monica wanted interbank lending. There we go. Okay. So that winds up your topic for today. Not a very big topic, right? So What is the expectation? Go home, go through your notes, and then go through the PPT. If any questions or doubts, make a note and we'll cover that in tomorrow's class. So we have covered the first 4 topics of your domain bit, which were the easier topics, right? Tomorrow we are going to start off with, tomorrow was FX or futures and forwards? In the schedule. Guys, hello?
Ma'am, we have to look, ma'am. Not remember.
It is futures and forwards.
Futures and forwards, okay, right. So tomorrow we'll be officially starting off with your derivatives class then, right? So from here on out,
Ma'am,
yes.
questions for this today's class.
I showed you, no, here.
Ma'am,
Yeah.
ma'am, I have a little doubt in certificate of depository.
Deposits, not certificate of depositories. Okay.
Please, can you explain third point of CD, ma'am?
So what was the third point that we wrote? 2, 3. So like your FD
Ma'am,
has
can be broken before maturity. Sometimes no penalty is charged. When they charge penalty, ma'am, anyone.
it depends on the bank that you do the certificate of deposit with.
Okay, ma'am.
Okay.
Okay, ma'am.
All right. Any other questions?
I'm just gonna. Could you please open the securitization portion? I just missed one line, ma'am.
Okay, just a second. I think I shut that down. Let me just open it. Here you go.
Ma'am, the Word file, not this one.
Acha, the Word file. Word file.
Ma'am, just before that, could you just hover over A17?
Here.
Yes, ma'am. After which I couldn't, like, it's not visible. All right. Thank you.
Okay. The theory part for securitization. Here you go.
Okay, ma'am, thank you.
Okay, Ajay, I'll follow up with Chandan on your issue with LMS. Did you try logging in through your phone or laptop?
Yes,
Ajay?
ma'am. I have tried both, but it's not working.
Did you try different web browsers and checking?
No, ma'am.
Try different web browsers. No? Were you trying on Chrome?
Yes, ma'am.
Try on maybe IE or some other explorer and see if it is working. If it's still not working, clear all the cookies from your web browser.
Okay.
Okay, and try. If it's still not working, let me know. I'll follow up with them. Is the WhatsApp group created for you guys?
Yes, ma'am.
Yes, ma'am. Yes, ma'am.
Yes, ma'am.
All right then. Okay, so are we okay for today?
Yes, ma'am.
All right.
Yes, ma'am.
Okay, so tomorrow we'll start off with futures and forwards, your first derivative class, right? So it gets, from here on, it gets a little bit more interesting and it gets a little bit slightly complicated depending on the product, right? But from this topic onwards, it's very, very important that you guys understand the basics. So what all we covered in the past few classes was the basics, like your shares and bonds, which are your basic instruments, or they're also called as vanilla instruments. Yeah. Could someone send Lekha the link for the WhatsApp group? Yeah. Okay. Right. So if that's it for today, then we'll wind up for today.